This video is for educational purposes only and should not be considered financial advice. The magic of trading the average true range with ICT Concepts. In this video, we will show you how to use the ATR, or average true range, to help refine your trades by keeping you out of bad trades while showing you where the good ones are. The average true range tells you the average size of a candle in pips over a series of candles. For instance, an ATR that uses 14 as the input will give you the average size of the candle and the pips of 14 candles. This can be very useful when you're wanting to know where you are in the average daily range, how much price can move by using the average of your time frame, and the level of volatility of your asset. The ATR can show you when price has volatility. If price is consolidating, then the ATR is going to be low. If you are a trend trader and you try to trade in a consolidating market, you know how frustrating that can be. The ATR can help keep you out of those types of conditions. Conversely, when price starts to move, the ATR gets larger. This can let you know that it's time to trade. Let's look at some examples on the charts. Here we have a 15-minute chart on Euro USD. You can see coming out of the Asian session, there is low volatility, and price stays below the threshold line that we've placed for the average true range. Then when price starts moving, we see the ATR move to a higher range and a higher threshold that we've placed on our ATR. The ATR of your time frame. When you are trading, you want to know that your chosen trade can go at least a certain number of pips. Otherwise, there's no reason to enter the trade, even if it fits your entry criteria. If you choose to trade on the 15-minute time frame and to enter on the 1-minute time frame, you can use the ATR to help you decide if there are enough pips left after you enter your trade. If you're looking to trade towards a draw on liquidity on the 15-minute chart, and the candle has to go a very far distance that is beyond the ATR, we know it is not likely to happen in that time frame. That can keep you from entering a trade that won't pan out. Let's look at some examples on the charts. For context, here we have a daily chart of the Euro USD that shows an average ATR of around 68 pips. And here we have an hourly chart of Euro USD that shows a liquidity area above equal highs on February 15th. We can also see in context that price had a big impulse move right here. When we draw a fib, we see that there has not been a retracement to the 50% level. Interestingly enough, that is where the liquidity is above the equal highs. So during the London session, we see a run on that liquidity. But if you were coming out of Asia, waiting for a London session trade, that's what you would be looking for. Here's that hourly chart close up, and we see the ATR is around 6 pips coming out of the Asian session. So we know that every hour for Euro USD at this point in time, price will move 6 pips. And if our London session starts at 1 o'clock, we're looking for a move inside of London between 1 and 4. Next, we move to the 5-minute chart, and we see coming out of Asia, price starts to give some volatility. It's still not above our threshold. However, when 1 o'clock hits, right here, price starts to move above our threshold, which is around 2 pips on a 5-minute chart. Then we see a break of structure and a move above the 4 EMA. So price comes back down, and that can be an entry. However, if you still want more confirmation and more volatility, you could wait till the London session really gets into swing, where you have another break of structure and then another retrace back into this fair value gap. Again, the hourly ATR is 6, and we're looking for a move above the liquidity on the hourly chart. And we're also looking for a move to the 50% level of the Fibonacci of the impulse leg. Price takes the liquidity, retraces, and then heads all the way up towards that 50% level. However, this is during London, and our hourly ATR is 6, starting at 1 o'clock, and we've reached 2 o'clock, and we've already gone 2 ATR. During the 1 o'clock to 2 o'clock, we've moved 6 pips, and then during 2 o'clock to 3 o'clock, we've moved another 6 pips, and now we're at 12. It would be a good idea to take some off of your trade or to collapse your trade because you've reached 2 ATR. And as you see, price begins to move back down, knowing where you are in the daily range. Lastly, if you use the ATR on the daily chart, you will know the average daily range that price moves. If price has already gone more than 70% of the average daily range, then it might not be a good idea to enter a trade to continue in that direction. Conversely, if price has gone its daily range, you might want to consider a reversal trade and look for entries in the opposite direction. Let's look at some examples. Again, here's our daily chart on Euro USD. Our ATR is around 68 pips. And here's our 15-minute chart. So continuing that trade out of London, we see price retraced and then broke structure again in between the pre-New York and the London session. It created a fair value gap, and then during the pre-New York session, it dipped back into that fair value gap. You could take an entry at that point. Now, if we use what we've just talked about, we know our daily range is around 68 pips, and we're looking to see where we are in that daily range. Well, coming out of London, we've moved 12 pips. If we see there is a lot more room to go, we have about 50 pips or so. So we enter this trade from this fair value gap, and then price makes a large move up. Now, you might be tempted to pull out of this trade because you already have a large move. Well, the question is, have we hit that 50% level of the Fibonacci retracement? And the answer would be yes, because right here is that 50% level. We have a 500 EMA, but this is actually where the 50% level is. So you might not enter this trade. However, we know that there is a large amount of space in that 1 hour fair value gap. So you can still enter the trade, but keep your stop tight. So there are a couple reasons why we would still enter this trade, even though we have hit the 50% level. One reason is that we haven't reached our daily ATR. The other reason is if we look at that hourly fair value gap, there is still a lot more space available, and we could potentially go up into this 1 hour order block. So price continues up, and we still haven't reached 68 pips, our daily ATR. Price retraces and then goes back up and then starts to stall around 60 pips. When you see this large engulfing candle, it's not completely engulfed, but it takes out most of the range of this up candle. That might be a consideration to exit the trade. And if we look on a smaller time frame, on a 5-minute chart, you'll see we engulf this 5-minute order block and then cross the 4 EMA. That would definitely be an exit signal. Now, you can also play the opposite side of the coin. Once that happens, you could actually enter on this 4 EMA. You could also enter on the retrace into this order block. You know that we've already gone 60 pips. The average daily range, or the ATR, average true range, is 68 pips in general. This could be an indication that we're moving lower during the New York session. You also see the 3 drive move happen here, which is also a market maker model. Level 1, level 2, and then level 3. Price moves back down, and we look at this area behind this swing level as liquidity, and the move is about 20 pips. So this is also a very nice trade during the New York session. To recap, using the ATR can help refine your trading and keep you out of bad trades. It can also help you find great setups because you have chart awareness and know what is possible in the time frame that you are trading in. If you found this video helpful, please like and subscribe for more videos like these. Also, please leave a comment if you have any questions or if you have any other video suggestions. Thank you for watching.